If you think that extra few $100s you made selling on eBay or driving for Uber is invisible to the IRS, you are walking into a financial minefield. The agency has unveiled a new automated system specifically designed to flag side hustle income, and they are no longer just looking for the millionaires. They are looking for you, and a single discrepancy between your bank account and your tax return can trigger an automated audit that freezes your refund and drains your savings. The scary part isn't that you owe taxes. The scary part is that if you don't report this correctly, the IRS is legally allowed to tax you on every single dollar you brought in without giving you credit for a single penny you spent to earn it. Welcome back to Tax Hack Pro. We are here to navigate the complex world of taxation so you keep more of your hard-earned money and stay out of trouble with the feds. If you want to bulletproof your finances against an increasingly aggressive IRS, you need to hit that subscribe button right now. We are building the smartest community of taxpayers on the internet, and we don't want you to get left behind. Today we are doing a deep dive into the new reality of the gig economy and the cash-based side hustle. This is not theoretical advice found in some dusty textbook. This is the raw truth about how the IRS data matching algorithms work right now, and exactly how they catch people who think they are flying under the radar. First, we need to establish exactly what falls under the umbrella of a side hustle in the eyes of the law. There is a massive misconception that you have to be a registered business or an LLC to be considered taxable. That is completely false. In plain English, side hustle income is any money you earn outside of a standard W-2 paycheck where taxes are already withheld. We are talking about the obvious ones like driving for Uber, Lyft, or delivering for DoorDash and Instacart. But it goes much deeper than that. If you resell vintage clothes on Poshmark, eBay, or Depop, that is taxable income. If you sell handmade crafts on Etsy or ship products via Amazon FBA, that is taxable income. It also includes the digital economy. If you do freelance work on Upwork or Fiverr, whether it is graphic design, video editing, coding, or consulting, the IRS is watching. Content creators, this means you too. Ad revenue from YouTube, the creator fund from TikTok, affiliate marketing commissions, and brand sponsorship deals are all squarely in the IRS crosshairs. Even the occasional cash jobs like dog walking, house cleaning, or landscaping, where you get paid via Venmo, PayPal, or Zelle, count. The law does not care if you did it part-time. It does not care if it was seasonal. It does not care if you consider it a hobby just for fun. If money changed hands in exchange for goods or services, the IRS expects a cut. So why is the crackdown happening now with such intensity? Why are they coming after the person making $3,000 a year from a side gig? The answer is simple: technology. In the past, auditing a small taxpayer was expensive and time-consuming. It required a human agent to sit down and review paper files. It wasn't worth their time to go after small amounts. That era is over. Today, the IRS uses the Information Returns Processing System, or IRP. This is a massive data ingestion engine. Platforms like PayPal, Amazon, Uber, and your bank are legally required to send data to the IRS. They track transactions, sales volume, and direct deposits. The IRS computers then take that third-party data and overlay it on top of the tax return you filed. It is a simple matching game. If Amazon tells the IRS they paid you $5,000 and your tax return lists $0 in business income, a human agent doesn't even need to get involved. The computer automatically flags your file and generates a CP2000 Notice, which is a terrifying letter essentially saying, "We think you are lying, and here is the bill." This brings us to the first major trap that destroys side hustlers. It is the belief that the amount is too small to matter. I hear this constantly. People say, "I only made $1,500, surely they have bigger fish to fry." Let me explain why this logic is dangerous. In the past, if you got away with not reporting small income, it wasn't because of a rule that exempted you. It was because you got lucky and the IRS didn't see it. Today, the visibility is 100%. Let's look at a concrete example. Imagine you did some freelance consulting and made $2,200. The company that hired you sends a Form 1099 to you, and they send a copy to the IRS. If you leave that off your return because you think it's insignificant, the mismatch is immediate. Here is the nightmare scenario. Let's say you spent $1,000 on software and equipment to earn that $2,200. Your actual profit was only $1,200. That is all you should be taxed on. But because you didn't report it, the IRS computer only sees the gross deposit of $2,200. They will send you a bill taxing you on the full amount. Now the burden of proof shifts to you. You have to fight them to prove your expenses, which takes months, causes stress, and often leads to penalties. It is always better to report the income and claim the deductions up front than to try and hide it. This leads directly into the second critical mistake, the missing form fallacy. There is a pervasive myth that if you do not receive a 1099 form in the mail, you do not have to report the income. This is one of the fastest ways to get audited. The requirement to file taxes is based on how much you earned, not on whether you received a piece of paper in the mail. Often, a 1099 gets lost. Maybe you moved and didn't update your address with a client. Maybe it went to your email spam folder. Maybe the platform just made a mistake and didn't issue one. It does not matter. The IRS position is that you are responsible for keeping your own books. If you try to tell an IRS agent, "Well, I never got the form," they will look at you and say, "But you got the money, didn't you?" That defense holds zero weight. You must track your own income independently of the tax forms. Think of the 1099 as a confirmation document, not the source of truth. If you rely solely on what arrives in your mailbox, you are handing control of your financial destiny over to administrative errors and postal service delays. We are going to go deeper into the cash economy in a moment, but first, if you're finding value in this breakdown and want to ensure you never overpay the IRS again, do yourself a favor and subscribe to Tax Hack Pro. We are constantly releasing deep dives like this to protect your wallet from government overreach. Now, let's talk about the third mistake, the cash is invisible myth. There is a sense of security among people who work in the cash economy, barbers, landscapers, private tutors, who think that because there is no digital 1099, they are safe. While it is true that cash is harder to track than a bank transfer, it is not invisible. The IRS looks for lifestyle discrepancies. If you report an income of $20,000 a year, but you are paying a mortgage, a car note, and credit card bills that total $50,000 a year, the math doesn't work. The IRS uses statistical analysis to identify these anomalies. Furthermore, once you take that cash and interact with the banking system, you create a paper trail. If you deposit cash into your account every Friday, that is a pattern. If you pay your bills with that cash, that is a trail. If you get audited, the first thing they will ask for is your bank statements. They will add up every single deposit. If the total deposits exceed your reported income, they will assume the difference is unreported income and tax you on it unless you can prove otherwise. And proving that a cash deposit was a gift from grandma and not business income is incredibly difficult without documentation. Mistake number 4 is an organizational disaster that I see all the time, commingling funds. This is when you mix your personal money and your business money in the same bank account. You use the same debit card to buy inventory for your Etsy shop that you use to buy groceries for your family. You use the same checking account to pay for your website hosting that you use to pay for your Netflix subscription. In the event of an IRS inquiry, this is catastrophic. The IRS agent is not going to sit there and untangle your mess for you. If they see a messy account where business and personal expenses are blended, they are likely to disallow your business deductions. They will say, "We can't tell what is what, so we are rejecting all of these expenses." Suddenly, your taxable income skyrockets. You end up paying taxes on revenue that should have been offset by expenses. The solution is incredibly simple. Open a separate checking account. It doesn't even have to be a formal business account if you are a sole proprietor. Just have a designated account where all side hustle income is deposited and all side hustle expenses are paid. This creates a clean audit trail that protects you. Let's move on to the triggers. What actually causes the IRS to pull your file out of the pile? We mentioned the automated mismatch, but there are other triggers. Large, unexplained deposits are a major red flag. Banks are required to report cash transactions over $10,000, but they also have internal systems to flag suspicious activity for smaller amounts that look structured to avoid detection. Another trigger is the ratio of expenses to income. If you report that you made $5,000 driving for Uber, but you claim you drove 50,000 miles and spent $20,000 on car expenses, that is a statistical impossibility that will get you flagged. The IRS knows the average profit margins for different industries. If your numbers look wildly different from the industry average, you are inviting scrutiny. Inconsistency is another trigger. If you report $40,000 in side hustle income one year and then $5,000 the next, but your lifestyle doesn't change, the IRS computers notice that variance. This system is efficient because it is automated. It costs the IRS pennies to send a computer-generated letter demanding money. That is why they can afford to go after the little guy. They don't need to send a high-paid field agent to your house. They just mail a letter and wait for you to panic and pay. So how do you sleep at night? How do you bulletproof your side hustle? The approach is not about hiding, it is about documenting. You need to become a relentless record keeper. You don't need expensive software like QuickBooks if you're just starting out. A simple Excel spreadsheet or Google Sheet works wonders. Create a sheet with columns for date, source, amount, and description. Every time you get paid, log it. Every time you buy supplies, pay for shipping, pay for software, or put gas in your car for a delivery, log it. Keep your receipts. Digital receipts are fine. Create a folder in your email or on your Google Drive specifically for tax receipts. Take photos of physical receipts immediately because the ink fades. By tracking this independently, you are no longer reliant on the 1099s. When tax season arrives, you compare your spreadsheet to the forms you received. If the 1099 says you made $5,000, but your records show 4,000, you now have the data to investigate why there is a discrepancy. Maybe the platform made a mistake. You can contact them to issue a corrected form. If you didn't have your own records, you would just have to accept their error and pay taxes on money you never received. Another crucial habit is setting aside money for taxes as you go. Unlike a W-2 job, nobody is withholding taxes for you. A safe rule of thumb is to set aside 25 to 30% of every dollar you earn from your side hustle. Put it in a savings account and do not touch it. There is nothing more painful than realizing in April that you owe $3,000 in taxes and you have already spent the money. If you are making a significant profit, generally over $1,000 in tax liability, you are required to pay estimated quarterly taxes. This is a pay-as-you-go system. If you wait until the end of the year, the IRS can actually hit you with an underpayment penalty for not paying throughout the year. Now, I want to address some specific myths that persist in the comments section of videos like this. Myth number 1, if I leave the money in my PayPal account and don't transfer it to my bank, it's not income. False. This is called constructive receipt. As soon as that money is available for you to use or withdraw, it is considered income by the IRS. Leaving it in your PayPal balance does not hide it from the tax man. Myth number 2, I don't need to report it because I don't have an LLC. False. We touched on this, but it bears repeating. The IRS defaults you to a sole proprietorship automatically. You are the business. Your social security number is the tax ID. Legal structure has nothing to do with tax liability on income earned. Myth number 3. It's just a hobby, so I don't have to pay tax. This is a tricky one. There is a hobby loss rule. If you're doing something purely for fun and not trying to make a profit, the IRS classifies it as a hobby. Here is the kicker. You still have to report hobby income. The difference is, with a hobby, you are severely limited in what expenses you can deduct. You generally cannot deduct expenses to lower your tax bill below zero on hobby income. If you are treating it as a business, meaning you are actively trying to make a profit, you get far better tax treatment on deductions. To prove it is a business, you generally need to show a profit in 3 out of the last 5 years. Myth number 4, I can just write off everything. No, you can't. You can only deduct expenses that are ordinary and necessary for your business. You cannot write off your entire rent just because you answer emails from your couch. You can only write off a dedicated home office space. You cannot write off your entire cell phone bill unless you have a dedicated work line. You have to calculate the percentage of business use versus personal use. Let's walk through a real-life scenario to see the math in action. This is where the rubber meets the road. Imagine you start a side hustle flipping furniture. Over the course of the year, you sell 20 pieces of furniture for a total of $6,000. That is the number that hits your Venmo account. However, you spent $1,000 buying the old furniture at yard sales. You spent $500 on paint, sandpaper, and varnish. You spent another $500 on gas driving to pick up and deliver items. And you paid $2,000 for a storage unit to hold the inventory. Your total expenses are $4,000. Total income, $6,000. Total expenses, $4,000. Net profit, $2,000. You are only legally obligated to pay income tax on that $2,000. Depending on your tax bracket and self-employment tax, that might be around $500 or $600. Now imagine you didn't keep receipts. You didn't track the gas. You lost the receipt for the storage unit. Or worse, you tried to hide the income, but the IRS saw the Venmo transactions. The IRS sends you a bill based on the $6,000 gross income. They don't know about the storage unit or the paint. They calculate tax on the full $6,000. Now your tax bill is closer to $1,800. You just tripled your tax bill simply because you were disorganized or tried to hide. And that doesn't even include the penalties and interest they will tack on for late payment and underreporting. This is why I tell you. Proper accounting is not just administrative work, it is a profit center. Every receipt you save is money in your pocket. Every valid deduction you document lowers your bill. The IRS has received $80 billion in funding to modernize their systems. They are investing heavily in AI and data analytics. The days of the cash under the table economy are rapidly coming to an end. The digital dragnet is too wide and too efficient, but this doesn't have to be something you fear. If you understand the rules, you can play the game to your advantage. You can take legitimate deductions. You can use tax-advantaged retirement accounts like a SEP IRA to shelter your side hustle income. You can structure your business to minimize liability. The people who get hurt are the ones who bury their heads in the sand. The ones who assume that because they are small, they are safe. That is a gamble you will eventually lose. Don't let a side hustle designed to bring you financial freedom become a source of financial ruin and legal stress. Take control of the data. Be proactive. Treat your side hustle with the respect of a Fortune 500 company, even if you're just making $500 a month. We are going to be covering more advanced tax strategies for freelancers and gig workers in upcoming videos, including how to legally deduct your vehicle, how to set up a home office deduction without triggering an audit, and when it actually makes sense to form an S-corp to save on self-employment taxes. If you want access to those strategies so you can keep growing your wealth, you know what to do. Subscribe to Tax Hack Pro. We are here to help you win the financial game. Thank you for your support. Stay organized, stay compliant, and keep hustling. I'll see you in the next video.